And Thursday was a whole lot of data that didn't amount to much. MBS were down 6 basis points real early. Bonds were already moderately weaker overnight following a choppy selling in Europe. The economic data is not helping for obvious reasons, meaning that all three reports were stronger than expected. First one coming in was GDP. So GDP came in at 2.9% versus a 2.6 estimate. It was 3.2% previously. When you look around out there, it sure doesn't feel like GDP is growing that much. But apparently it is. Consumption rose 2.1%. There we go. Like I've been saying, people just keep spending money. Investment increased 1.4%, and government spending rose 3.7%. Yeah, that's what happens when you approve of a $1.7 trillion budget or whatever that was. Inventory build, particularly in the natural resource sector, was a driver for the increased GDP print. Housing services, house price appreciation, owner equivalent rent pushed up GDP, while actual residential construction was a drag. The housing services component will fade into the background as home price appreciation stagnates. Jobless claims came in at 186,000 versus a 205,000 estimate. Just keep beating that number over and over again. It was 192 previously, so people are staying in their jobs so they have more money to spend and keep that inflation high, apparently. Durable goods came in at 5.6 versus a 2.5 estimate. Wow, big beat there. Core durable goods came in at minus 0.2 on a minus 0.2 forecast. It was 0 previously. U.S. economy expanded at a healthy pace in the fourth quarter, though signs of slowing underlying demand mounted as the steepest interest rate hikes in a decades threatened growth this year. Personal consumption, the biggest part of the economy, climbed to a below forecast 2.1%. PCE price index, the Fed's preferred measure of inflation, rose 3.2% compared to 4.8% the prior quarter. It's supposed to be 2% on the year here. Excluding food and energy, the price index rose 3.9 versus 4.7. New home sales rose 2.3% month over month to a seasonally adjusted annual pace of 616,000 last month, according to the Census Bureau. This is down 26.6% on a year-over-year basis. We need more houses. They're just not building the houses people want. I don't know what's going on here. These builders are confounding. For the year, an estimated 644,000 homes were sold in 2022, which was 16.4% decline from 2021, or it could be just that people don't want to wait a year and a half to get into a home they buy. There were 416,000 homes for sale at the end of December, which represents a 9-month supply. Generally speaking, 6 months is considered a balanced market, so the builders have inventory to go. Maybe they'll get them into some reasonable prices. Thursday morning's economic data provided one of only 2 major opportunities for this week. Scheduled events to ruffle the bond market's feathers. Despite the trifecta of strong numbers, claims, GDP, durable goods, bonds were right back to pre-data levels in less than an hour. Granted, we closed slightly weaker, but a lot of that stuff had come from earlier in the day. This places all the more focus on next week's events, including both ISM reports, non-farm payrolls, central bank announcements from the Fed, Bank of England, and ECB. At the end of the day, we were down 19 basis points, ending up at 101.34. So that puts us right in the middle of this ever-consolidating range where we have the Fibonacci 38% retracement at 101.671, which has been holding real strong. And then basically the floor on that is the convergence of the 25 and 50-day moving averages right around 101.059. So it's kind of nice to have a little bit of stability. I know we want everything to get better. Before we can get better, we got to get some stability. Goldman Sachs came with some very dire news. The Goldman Sachs, they're Goldman Sachs. They know a lot of stuff. Sees a 2008-style decline in 4 cities, including Phoenix. Oh, man. Guess where I live? San Jose, San Diego, and Austin, Texas. The bank sees declines of around 25% for these MSAs. Note that such a decline would put them above pre-pandemic levels given the insane appreciation over the last 2 years. So it won't bring them down to 2008 levels, just meaning those places might see some gigantic drops. We also got a post from our sponsor at WellThatMakesSense.com. This is a 9th. I believe is our last post from the great book Traction by Gino Wickman. If you have goals for this year, and you damn well should, Traction is your system for getting them accomplished this year. So this sets out the framework for your meetings, for working with your team and working with everybody to get your goals accomplished. Check it out on our sponsor at WellThatMakesSense.com.